So here's a puzzle for you. On one side, you've got Warren Buffett, probably the most successful investor of the last 100 years. And on the other side, Bitcoin, the most explosive asset of this century. And these two things, they are in total opposition. How is that possible?
I mean, it really makes you wonder, right? Why would a guy who is an absolute master at making money go out of his way to attack an asset that's made so many people incredibly wealthy? This isn't just him saying, not for me. No, this is a deep, fundamental rejection. And to get why, you really have to get how he sees the world.
And he does not hold back. Rot poison squared. I mean, wow. That's not just some dry financial analysis. That is a serious warning. It's so intense that you have to ask, what is he seeing that so many others are missing? Is this the wisdom of a genius, or is he just missing out on the biggest thing of a generation? Well, the answer is actually shockingly simple. See, for Buffett, the entire universe of things you can invest in is split into just two, completely different worlds. It's a simple framework he's been using for his entire career. And once you understand it, his view on Bitcoin becomes perfectly clear. It has nothing to do with technology or the future of currency. It's all about this one core idea. And this is it. This is the key. On one side, you have productive assets. Think about a farm. It grows crops, it produces food, it creates real value every single year. Or think about a company like Coca-Cola. It makes a product, sells it, and generates profits. But on the other side, you've got non-productive assets. Look, if you buy a bar of gold today, in 100 years, it's still just a bar of gold. It hasn't done anything. Its value is based entirely on the hope that someone down the line will pay you more for it. And for Warren Buffett, Bitcoin fits right into that second bucket. It's what he'd call a sterile asset.
Now, within that first world, the world of productive assets, Buffett is looking for one thing above everything else, something he calls an economic moat. You know, like a moat around a castle. It's a powerful, lasting advantage that protects a company from its competition. It might be a brand that everybody loves, like Oppo, or a crazy cost advantage like Costco has. That moat is what guarantees a business can keep churning out cash decade after decade. So for Buffett, the question is always, where's the moat?
And just to be super clear, this isn't some special rule he made up just to hate on Bitcoin. Oh no, this logic is something he applies to everything. He has a very long track record of completely avoiding entire industries that just fail this basic test of being a productive, efficient place to put his money.
He actually calls them gruesome businesses. His first big investment was a textile mill, and it was a total nightmare. It was constantly bleeding cash, needing expensive new machinery just to keep up, and the returns were awful. And don't even get him started on airlines. He famously calls them a bottomless pit for your money. You see the pattern? These businesses just eat capital instead of growing it. Bitcoin, in his mind, is even worse. It doesn't even use the capital. It just sits there.
Hey, if you thought Warren Buffett was blunt, his longtime business partner Charlie Munger is on a whole other level. Munger looks at the speculative craze around crypto and doesn't see investing at all. He sees it as a kind of mass delusion, driven by nothing more than the fear of missing out, or FOMO. His point is that the thing being traded doesn't even matter. It's all about crowd psychology.
So this table really just boils the whole philosophy down. A productive asset makes money, so you can actually sit down and rationally figure out what it's worth. Your goal is to own a piece of that growing machine. A non-productive asset? It makes nothing, so you can't value it. You can only guess at its price. Your motivation is purely speculative. You're just hoping the next person who comes along is willing to pay more. For Buffett, one is investing, the other is gambling. It really is that simple.
But this is where the story gets interesting. Warren Buffett is not going to be in charge forever. His hand-picked successor is a guy named Greg Abel. And with the new captain about to take the helm, everybody's wondering, are the old rules about to change?
You see, unlike Buffett and Munger, who will tell anyone who will listen how much they dislike crypto, Abel has been completely silent on the topic. Hasn't said a bad word about it, but he hasn't endorsed it either. And that silence has fueled all kinds of speculation. Is he just being polite, waiting his turn? Or is he maybe a little more open-minded?
And then, Berkshire Hathaway did something that looked like it completely broke their own rules. They invested $1 billion, $1 billion, into a company called New Holdings, which is a Brazilian digital bank that is heavily involved in crypto services. $1 billion seems like a pretty big deal, right? Well, hold on a second. Because while $1 billion is a massive amount of money to you and me, for Berkshire's enormous portfolio, it's a rounding error. It's just 0.3%. This is not a pivot, it's a tiny calculated bet. And get this, they weren't buying crypto.
They were buying a piece of a fast-growing digital bank that has a powerful moat in the Brazilian market, a bank that just so happens to offer crypto to its customers.
And that move right there, it tells you everything you need to know about the future of Berkshire under Greg Abel. He's not throwing out Buffett's playbook. No way. He is adapting it for the 21st century. He's hunting for modern moats in a world that's gone digital.
So here's the new playbook. Abel is an expert in energy infrastructure. He looks out at the world and sees this massive revolution happening with AI and the digital economy. And he knows that all of that, it's going to need an unbelievable amount of electricity. So, instead of trying to pick the winning AI startup, which is super speculative, he's investing in the power plants and the power lines that AI absolutely needs to run.
This is the modern moat strategy in a nutshell. It's the old saying, during a gold rush, don't dig for gold, sell the picks and shovels. In this case, don't bet on the AI software, bet on the boring old utility company that powers it. It's predictable, it's tangible, it produces cash, and it has a massive moat. It's a classic Buffett investment just applied to a modern-day problem.
Which kind of leaves us with one last big question to think about. As our world gets more and more digital and our assets become more and more intangible, does that old-school wisdom from Warren Buffett still hold up? Is the smartest, safest bet still on the real, physical stuff that makes it all possible? That is the billion-dollar question that Berkshire Hathaway is betting it has the answer to.